Now we're recording. Okay. I don't know how many times I've gone through this, but finally I think we're going to get the recording. Okay. Chapter 11, Section 11.2. Now, Mrs. Robinson has the controls to this. She can stop and start this video, or we're going to go straight through it, and she can play it for you again at the end so that you can get all the notes that you missed the first time. However you do it, be sure you take the notes. Don't fuss. Don't argue. Don't be talking, or you can't hear my voice along with the lecture or along with the slides, okay? I'm going to be giving you more information than just what's on the slide, and it'll help you understand, and I may even ask you for that. Okay, this is part of your notes. You need to understand this, not necessarily write it down. All right, we're talking about bonds. Yes, bonds. Financial bonds. Go ahead and groan. I give you that permission this time. All right, bonds is financial assets. Bonds are basically loans taken out by the government or government-related groups or companies even, and they will be repaid to the investor with interest. Okay? Bonds are usually low-risk investments, low-risk loans. That means the return is also less than some of the other investments that are classified as high risk. Now, there's three components of a bond, three parts of a bond. All right, first, number one, coupon rate. That is the same as the interest rate that is to be repaid. Okay? That is the same as our key term, yield. So yield equals the interest rate, which equals the coupon rate, which equals yield. It all means the same thing, and it all adds up to the money that you are paid in addition to what you originally give the company or give the government. You're paid that back in the end. Maturity, number two, maturity, that is the date when the loan is finally paid off or when it is finally due. Okay? Number three, I don't know where they get this term, but it is par value. Okay? It is the same as the face value of the bond. The face value of a $1 bill is $1. The face value of a $10 bill is very good, $10. Yes, I certainly hope somebody shouted out $10. This is the amount that you pay in that will be paid back. It is the face value of the bond, what it's worth on its face, but in the end, you also are paid back the coupon rate, the interest rate, when it reaches full maturity. Those are the three components of a bond. The great thing about these bonds, they can be bought and sold just like stocks. Okay, there are bond markets, there are other financial markets that you can buy these bonds on. There's also the stock market. You can buy all these things, you can buy and trade these things, and you make money off these things. They're great. You can also buy them at a discount. No, not at Walmart, not at Target, okay? But you can get them at a discount. All right, for example, you could buy a bond with a par value of $1,000, okay, but only pay $960 or $900 or something like that, a discounted rate. Sounds like a great thing because after all, if someone offers you a $5 bill for giving them three $1 bills, who wouldn't take that deal? Right, it's a good deal. However, why would someone discount a bond? Well, here's why. Bonds are rated just as we as individuals have our credit rating, which affects the interest rate we pay on loans. Companies, governments have bond ratings, which affects the interest rate they have to pay, also affects the value of the par of the bond. Now, a $1,000 bond is a $1,000 bond, but what do you pay for that $1,000 bond? You could get a discount, but it would be because the company or the government that issues that bond is not rated as high or as trustworthy as another company. All right? government or companies want the highest bond rating possible. One group that rates all these all these companies, all these governments for just this reason is called Standard and Poor's. Okay? Their highest rating is a AAA rating. The U.S. government enjoyed a AAA rating for a long time until it became evident that there was a real risk that our government was going to default on some loan payments. Not on the whole loan, but just on the payment that was coming due. And because of that, Standard & Poor's knocked us down to a AA rating. Now, I don't know if our rating is still AA or AAA. Hey, that would be a great thing to ask on a test, wouldn't it? What is the U.S. government's current Standard & Poor's rating? Let me underline that. So you might write that down in addition to what's in your notes, something you have to find out that I might ask you. All right. A higher rating on the bonds or on the company issuing the bond might mean that you'd have to pay above face value for those bonds. In other words, for $1,000 par, you might have to pay $1,100. Why? Because of the higher rating of the company. Okay, the higher the rating, the higher the price of the bond, and that's great for the company selling these bonds. That means they get more investment for the bonds that they're selling. It's also great for someone who has already bought bonds with that company. If their bond rating goes up, that means the value of their bonds also goes up. So that's good. With bonds, there are advantages and disadvantages. All right? Once the bond is issued, all right, the coupon rate will not change. The interest rate will not change. That's great news for the company. Not so great news for the investor. If the company starts doing better, you don't get more money from your investment. You get the same amount of money. All right? But you do get your money. So that's a good thing. Number two, bondholders do not own a part of the company like stockholders do. They only own part of a company's debt. Now, that's generally a good thing all around, unless you're just aching to get involved in some company's business. That's a good thing all around. Number three, if the company does poorly, the bonds could be downgraded, and that makes them harder to sell or liquidate. And that's never good for the investor. It's not good for the company either. So if their bond rating goes down, it's bad news all around. All right, several types of bonds. 5 types of bonds. There's the savings bond. This is the type of bond you're probably most familiar with. They're sold by the U.S. government. Interest is paid when the bond matures, not monthly as a regular bond payment would be. But when the bond matures, then you can get the full interest, the full par value and everything at one time. The original bond is actually discounted. This is a good thing, the only good time that the bond is discounted. A savings bond is generally half of the par value when you buy it originally. My parents bought savings bonds for our children when they were born, and for a $100 savings bond, my parents paid $50. Okay, a great bargain, a great discount, but my kids could not touch that savings bond for I can't remember how many years, 10, 15, 20 years, can't remember right now, but that's the time you have to wait until it reaches full maturity. And then only my kids could redeem that bond because they are the original investors, what the government considers the original investors. Another type of bond is the treasury bonds. Treasury bills or treasury notes, also called T-bonds, T-bills, and T-notes. All right, these are issued directly by the U.S. Treasury, backed by the full faith and credit of the U.S. government. Okay, that was a big deal. Right after 9/11, people bought T-bonds and T-bills and T-notes like crazy, because they felt secure in our government because we were responding to this attack. Even though we were attacked on our own soil, our people had full confidence in our government and invested heavily in our government through these bonds. Okay, typically you can resell these bonds at any time. Municipal bonds are the same kind of government type bonds, but sold by city governments as well as state and county governments, by school districts. Okay, they sell municipal bonds. The money from these bonds typically go toward public works of some sort, upgrade of streets or things like that. But they have the backing of whatever government group sells or issues those bonds. All right, corporate bonds also, of course, sold by corporations. All right, they have higher risk than those issued by governments because companies have a higher risk of going under than governments do. These bonds are backed by future profits. Okay, they are not backed by tax money. They're not backed by confidence in your government. All right, they are going to be paid back by future profits. So if a company goes under, you lose your money. These bonds are regulated by the Securities and Exchange Commission, the same government group that regulates our stock market. Last type of bond is called junk bonds. They have the highest return of any bond, but there's also a higher risk of default on payments. Hence the term junk bonds, because a lot of times all they're worth, they end up just being junk. They're not worth anything, but they're just paper. Okay, if you are lucky enough to trade in these and make a profit, feel lucky. These are not the most secure way to build wealth, though. So those are the 5 types of bonds. There are other types of financial assets. We've talked about both of these types. Certificates of deposits. This is where you put money on deposit with a financial institution, and everybody agrees you're going to leave the money in there for a specified length of time. The bank will give you that money back with a high interest rate as well. And so you're making money by leaving that money with the bank. The bank turns around and invests that money themselves, or they extend them out at loans or whatever. The bank makes money so that it can pay you money. All right, but certificates of deposit wrap up your money in a specified amount of time, which you really can't get out of without paying fines. The other type of financial asset we want to look at are money market mutual funds. This is where a group of investors put their money into a fund that is managed by a financial institution, typically a bank of some sort. That institution buys stocks, bonds, other assets on behalf of this group, but the group only gets the payout. They get their original investment plus the payout. They don't get ownership in the company at all. They're just getting the money from the dividends and whatnot. Now, you receive higher returns for this, but there is a risk. These money market mutual funds, even though they're deposited with a bank or with a financial institution, they are not covered by FDIC. And so if the institution goes under or if the fund goes under, you lose your money, and that's it. Where do you get these things? Financial asset markets. And the types of financial asset markets are either described based on the length of the time the investment is made for, or it's based on whether the asset can be resold. All right, time-based classification, you have capital market for investments that last longer than a year. Long-term CDs, government or corporate bonds, like our savings bonds that we were talking about, takes many years to mature. Long-term CDs like 24, 60-month CDs, those things are capital market investments. Money market investments are shorter than a year. They're closer to being like cash. They're short-term CDs. They're T-bills or money market mutual funds, which are typically short-term investments. If the asset can be resold or not, that determines whether you're in a principal market or a secondary market. Principal market is where only the original investor can redeem the asset. Savings bonds are one of those things. Small certificates of deposit are typically in principal markets because there's not enough time for the original depositor to resell that to anyone. All right, so principal markets are where the original investor only can redeem the asset when it's mature. Secondary market is where the assets can be resold to other investors who may resell them still to somebody else, or they may hold on to them until they mature and they can redeem them for their value later on. And almost all the other types of financial assets fall into secondary market. Okay, that's all our notes. I hope that's all because I've been trying to record this I don't know how many times. So hopefully this comes out this time. All right? If you need to play it back, fine, but hopefully maybe Miss Robinson has been stopping it along the way and letting you get your notes down. Okay? But you need to have been listening to what I've been saying because there's a few things that I have a feeling may end up on this test, on this quiz, that I just said that you really should have written down because I emphasized it so many times. Now, check question. Describe 5 different types of bonds. Don't just name them, describe them. Tell a little bit about them. All right, put it into your own words so that it is as short as possible. Well, by the time you're hearing this, the band has already done its bit at contest. We know what we've done. Maybe Mr. Alban has already had an announcement made. But I will see you tomorrow, and I hope to have nothing but good news from Miss Robinson on how you behaved. So have a good rest of the day. Thanks.